Well, good afternoon. If you have read the agenda carefully, you read treasure hunting, or treasure hunters, I should say. And as with all titles, I think we also are a bit nervous about this, because I think we neither have fortune hunters nor adventurers here on the stage, but rather hard workers to really generate value. And therefore, we would be rather careful with treasure hunters. We don't want to disappoint you. I'm sure we can help you find some value, but we are not looking for the big fortunes. We are looking for really long-term value. So let me introduce my fellow hard workers. Tom Finke, from the CEO of Babson Capital Management. On your left-hand side, then Paul Howard, CEO of Orchid Global Asset Management. Rob Petty, Managing Partner and Co-founder of Clearwater Capital Partners. And last but not least, Takumi Shibata-san, Representative Director, President, and CEO of Nikkei Asset Management. Now, we've heard already this morning there's a lot of nervousness in the markets. We've seen, especially the Chinese market, having come down quite strongly. And as Mike has said, interestingly enough, if it had just grown by 60% rather than going up by more than 100 and then coming down, people would be really happy. With the same results, being up 60%, but after having come down over the last few months, people are very unhappy and very nervous. The same is true in many other markets. And of course, today is the big day when so much has been said about so little, the 25-point potential rise by the Fed. Is it coming? Is it not coming? So lots of nervousness, lots of uncertainty, but I think we can really help you find opportunities for generating value. And so I would like to get started with Tom and see, Tom, where are you looking? And what are the regions, the asset classes that you find interesting?
Sure. Well, to start, our approach to managing money as an institutional manager, it's not like we have the luxury to just move around from sector to sector. We're typically investing through the cycle in asset classes from global fixed income to global private credit, commercial real estate, and alternatives. In this environment, and certainly over the last few years, you've had the challenge of an increasingly tighter environment in terms of lower interest rates. The good news for us is we spend years investing in the high yield markets in the U.S., in Europe, and actually in Asia Pac, and doing direct middle market lending. So when we look at it through the cycle and over those years, we've seen better value from time to time between the U.S. or between Europe. Certainly, I think Asia Pacific, when you look at high yield credit and private credit, is a very interesting place. There's not as many players in that space today, so we tend to see a better relative value in Asia Pac leveraged finance. But that's not to say we don't see value in the U.S. and Europe at the end of the day. So we do think a lot of people are saying in the high yield credit markets, for instance, are you in a credit bubble? Really, if you look at it relative to 2007, I don't think we're in a credit bubble. We're certainly long in a cycle where you have to be very good at picking fundamentally good investments. But that's really what we focus on. So high yield we like. And in particular, we are allocating and continue to invest through the cycle in global private credit.
Paul, we said earlier we would take different views and maybe even contrarian views. Where's your focus and where are you finding value?
Good. Well, as those of us who know me in the audience, contrarian is my middle name, so I'll try not to disappoint. Look, I actually think the title of this panel, is one of the reasons why I'm happy to be on it, is very appropriate for the market that we're in right now. Treasure hunters. And why do I say that? For all the reasons that Tom referred to, central bank intervention, tight rates, potential for asset bubbles being created. I think actually we are in one of the toughest investing environments in a really long time. And if I were sort of a Harvard Business School professor, I'd spend the next 25 minutes sort of backing that up, but I think we can all agree. And I would say the reason being is that I would say all asset markets, but I'll focus on where we focus, which is global credit and global private credit. The problem that you have right now is almost anything that you can think of, almost, we'll talk about the exceptions, the treasurer in a second, almost anything you can think of is yielding less than it was 2, 3, 4 years ago. And most people perceive that the risk is higher on those assets than they were 2, 3, 4 years ago. Now, what we've tried to do is actually focus on those areas or that area that's bucking the trend. And we think we found it, and we've been employing that for the last, at least since before the global financial crisis. And for us, and I'd ask if we went to slide number 1, for us, we think there's one very, very big and sometimes overlooked by some of our asset management competitors, treasure chest out there, and that's the banks. So if we can go to slide
number
1,
please.
There we go. So pretty simple slide, but I wanted to put it up there so you could read it and read it and read it. The top 30 banks in the world control $53 trillion in assets. That's a pretty big treasure chest. And the banks still have globally, it's true globally and as well in Asia, they have some jewels in those treasure chests. Now, not every asset in every bank is good. But since there's only 30 of them, and for those of us who've been, I started out my career at the Federal Reserve during the savings and loan crisis, and what I learned there applies today. If you pick those banks, most banks got to be a top 30 bank by being really good at least at one thing. And if you team up with those, the biggest banks in the biggest countries and the best portfolios, the one thing they're good at in the bank, that's where that diamond or that ruby or that particular treasure is. And so if you sit and you say, well, wait a second, if most things are yielding less and they're riskier, but by hanging out with banks, we're actually finding in the last 2 years that we're getting better returns per risk unit taken now than we were 2, 3, 4 years ago. Well, that to me is...
Take it from the banks.
Exactly. Is my definition of treasure. So the bank's ills and the subsidy that the bank has to give to get us to sort of take that risk off their hands, that is the source of the treasure. And just to give you a flavor for, some people say, and we were having a discussion actually just while we're getting ready, scalable, niche, where do you go? And what I like about, at least the approach we take, it's a niche strategy, but it's very scalable because the number is 53 trillion. If we could just go to slide 2 really quickly, we can give you a little bit of flavor. So under the old rules, so-called Basel II rules, the pre-global financial crisis rules, banks needed to have a 2% equity to assets ratio. Now, 08, 09 almost ended sort of Western civilization and Eastern civilization as well. So the central bankers got very upset, and they said, we're going to change that. Now those top 30 banks have to have at least 9.5%. So going from 2% equity assets to 9.5% equity assets, or a 7.5% difference on 53 trillion, well, that's a $4 trillion problem that the regulators just handed to the banks with the stroke of a pen. And that's being dealt to the very banks that lost $2 trillion in the global financial crisis. So that's the reason. That's the reason. And now that's been around for 5 or 6 years. With the asset quality review test in Europe in Q4 of last year and the stress test in the US, the regulator said, we mean business. Mr. or Mrs. Bank CEO or CFO, you really do have to get into compliance with those rules by 2018. And that's where we're seeing the treasure. And the final kind of comment, because you asked us to talk about how we're different and how we,
Absolutely.
is if we can go to slide 4 really quickly. Now, I don't think we're terribly unique in saying that, banks have a problem and we're going to take advantage of that. But here's where I'd like to differentiate, I think, our approach from many other asset managers. What most asset managers, with all deference to leading asset managers like the one on this panel and sponsors of this conference, what they're saying is the banks are finished. They're gone. And what their strategy is a disintermediation of banks. We're going to go around the banks. We have the opposite strategy. We are actually working with the banks to disintermediate the disintermediators. I guess, Hans, you and my wife are both from Nordrhein Westfalen, so we'll use that as an example. I tend to believe that bank manager in my wife's hometown, and it sounds like close to your hometown of Düsseldorf, is going to be better at deciding that steel-producing supplier is better than that one. Because he or she went to school with that supplier and they repay their debts and that other one doesn't. And I fundamentally believe that banks are better at doing that in origination than, not to pick anybody out, but some 20-something, kind of punk in Newport Beach with a kind of F9 computer. That's what I think. I'm not talking about anybody specific. I just picked that city randomly. But so I don't think banks are dead. I think that they are actually very good at originating, at servicing, at underwriting, and God forbid, working out those loans. The problem is the rules have changed. So what for those of us who want to find the best treasure, the bucking the trend, the better risk return now than 2, 3, 4 years ago, and pull that ruby or diamond out of the treasure chest, what I'd argue is team up with the banks, they originate, share the risk. Not to pick again on California, none of this countrywide credit. I originate from the illegal alien who made up his or her income, and I put it into some sovereign wealth fund. No. Share the risk, and enjoy the return. So that's our sort of alternative treasure finding controversial statement for the afternoon.
Okay, very good. Rob, so what's your special approach then?
So as the third individual who's talking about private credit and absolute return in the world, I'm sort of thoughtful how to differentiate and how to think about that. But let's try and take a different tack on the same theme, because I would share broad observations with the fellow hunters out there that, frankly, in a volatile world, and I think there's one thing we can all agree on, the world is volatile, and volatility can scare you or give you opportunity. We're in a volatile world. Going at the top of the capital structure is a risk-adjusted, let me repeat that, risk-adjusted return way that is really particularly compelling in a 1% world. We are in a 1% world, and maybe they change it by a quarter. I don't really care. But there's a 1% world out there in the risk-adjusted return in fixed income, and we would take one step further there in private credit and, frankly, in the least understood, least competitive markets of the world, and that's Asia. Right? So for 15 years, myself and 90 of my fellow colleagues across this region, excluding your fine country, part of the 1% world, we find absolute return across markets with fewer competitors, where the banks, with all due respect, we love to avoid because we don't think they're necessarily such good hunters that I want to partner with. I frankly want to go where they're not. But those same principles do hold. Higher absolute returns, benchmark rates, China and Japan, we are able to do top-of-the-cap structure deals, 20% average portfolio yield right now, 2 direct lending platforms, one in China, one in India, average yield 18.8%. Absolute return, senior, cash on cash, 50% loan to values. So credit, misunderstood, relatively niche strategies, frankly, in a volatile world, is a really compelling place. So I will also just try and get you to think differently about places of the world that you may not travel to and ask you to put up slide 8. But before slide 8, just think about it. How big is the Asian credit market? What is the single biggest part of emerging market credit, emerging market asset class? If you want to invest in the emerging markets, what's the biggest place to go? You said 53 trillion if you partner with the banks. Slide 8, please. What's your guess? 35, slide 8 somewhere, $35 trillion market. And how many asset managers do you know doing credit across Asia? 70% of that is in loans. So I buy your thesis that the credit space is a loan-dominated space in Asia as well. So think about the credit space. It's just bigger than you think. And frankly, there are a whole lot of places where very few people are. Secondly, and I invite you to pop up and take a look at page 9, this is the opportunity around that for the next episode. Volatility creates opportunity, and you can get scared by this slide or get excited about this slide. And frankly, as contrarians, we get excited by this slide. So just what are we saying here, right? Mr. Milken put up a very interesting slide that was more or less the same sort of thesis, right? You can get scared by the volatility. You can actually recognize it's steadily going, and you're making money all the way. This is an equity chart, MSCI. So China's basically not in here. This is also post the global financial crisis. So the big global chart that we've all tried to figure out, the point is every single year since the global financial crisis, the markets go up and the markets go down. And if you breathe, and I would argue particularly in our markets, have long-term capital with contrarian patience, great way to make money. And I think volatility and this theme, so the two themes we think of are stay focused, long-term, do your homework. In a volatile world, it will yield you results. And catching a falling knife is hard but profitable. And second of all, in that bank and that bank disintermediation private credit world, there is a whole host of misunderstood and still long-term capital market evolution value, especially in Asia.
Very well. Now,
I was going to say, can I just follow up that point with slide 6?
Can we go back to
slide 6, just real quick? Because I think that's a very good point. This volatility, but go to slide 6 instead. This is a default chart, and you see the big spike in 2009 was coming off the financial crisis, and this is U.S. loan default history. The point being is that with all that equity volatility, we've actually had a fairly benign credit cycle. And so sometimes we get caught up in the equity story, and we look at the equity volatility. But what we're looking at is underwriting, whether it's in the U.S. or Europe or Asia Pacific, companies that are operating that, while being levered, still have good financial structures, and in an environment where defaults are actually below trend. I actually think with oil prices backing out a little last fall, a move up in defaults a little bit isn't the worst thing in the world. Sometimes you just need the market to rationalize. But the equity volatility relative to default tells you something about the relative volatility of the equity markets versus global loan markets.
All right. Now we go to the equity markets, and Shibata-san, I think you're focusing on that. And
first of all, I think
you should be envious of all the returns that they are generating.
Oh, yeah. And the fixed income
17, 20%.
Actually, in the final round of 30 years of good time, but still provides a very good opportunity to earn yields. So quest for yield still continues, and it is highly unlikely to go away. So don't move away from those credit products. And also, I like taking advantage of stupidity of regulators, banking regulators, to raise the cost of funding for financial service industry, especially when the risk of financial service industry is low. Okay? They are under pressure from the government regulators to behave like utilities. And the current set of hybrid securities that they are issuing actually is priced as if it's paper issued by highly risky entities. So you're taking advantage of a great trend. And also, I do agree with the opportunities for the fixed income area in the Asian area. So with that, I think I need to basically go to my own slide. If you could put up page 1 of slide, you would be interested in seeing. Can you do that?
No, that's not.
Next one. If you have a problem, then I can speak from my memory. Don't worry. It looks as if the slide is missing. So imagine that there is a slide in your mind. Okay, first slide will tell you it's a 2x2 matrix. Straight up, you have danger. Horizontal axis, you have a sort of stability. And that's a sort of how you look at the global geopolitical risks. If you have to imagine the first 25 years after the World War II, you have a very stable geopolitics environment. You could guess it's always United States fighting against clients of Soviet Union, and it was very dangerous because any mistake could wipe out the entire world. But it was stable. Next 25 years, you had very unstable world, but not that dangerous. Because the West was busy picking up pieces of what was formerly the Soviet Union and the Soviet blocs, with Soviet Union being unable to do anything. Now it looks as if we are moving into next 25 years where things are not stable and things could be very, very dangerous. You have various sort of time bombs ticking in the Middle East, spreading into Europe, Ukraine, rising tension over here. Any mistakes can lead to a very major disaster. So geopolitics, I would say, is going to be somewhat more important than in the past. But in the past, you could take politics for granted. So we are now testing with the idea of combining multi-asset allocation with the geopolitical overlay because we think that represents new trend for the next 25 years. Second, if you have to look at fund managers, okay, these guys are wonderful because they do all the investments on the conviction basis. They don't invest in thousand securities. They invest in papers that they can understand, and it's called conviction investment. The problem with the typical asset managers is that when you find a very good portfolio manager investing in 250, 500 stocks, and look at what they're doing when they build a portfolio, say, you ask a question, what are you doing? Oh, this is my conviction. I'm diluting it with water. Water is actually index. Okay? But all sort of men and women in this room knows that it's expensive to order drinks in bars and the restaurants, and especially when you order whiskey and water, the price goes up. And probably it is for the benefit of investors to buy Johnny Walker and buy mineral water. And you pay the price for Johnny Walker, and also you pay price for water, mineral water, and it's much cheaper. And also you can adjust your exposure with your own risk profile. So I contend that the next over 20 years will be the age of a more conviction investment, finding its way from private equity boys into public equity world. So we're also betting on a 45 stock portfolio of global equity, high conviction. By the way, they are beating the index by about 6%. And also high conviction Asian equities, I love Asia, who are beating an index by about 8%. So you pay money to those who do the trade for you, but you don't pay money for those bartenders who mix water with this Johnny Walker. So conviction investment is going to be a very important theme
Well, I have to, well, as no stranger to drinking whiskey and water, I have to agree with a couple things you said, but I'd like to maybe push back on one thing that you said. I think you're absolutely right. I think the geopolitical risk going forward is large and growing and more dangerous. And any strategy that doesn't recognize that will do so at their peril. My only issue there is they're kind of hard to predict and they can often be hard to hedge. And I very much agree, and whether it's true for sure both in equities and as well in the world of fixed income, for the near and foreseeable future, this is definitely not the market to buy the market. You absolutely have to have conviction. And so we're not just talking about, see, I don't think Johnny Walker's the right one. I'm talking like cask strength, Springbank, single malt. You don't want to buy that blended stuff. You want to be very specific, and you want to really, so agree with your point about geopolitical and the volatility it creates. Agree that you have to have a conviction, but I think a lot of conviction. But the other thing, though, and not to sort of, since there's three of us and only one of you, not to gang up too much of the private credit versus the equities, even high conviction equities. I think there's one thing, volatility or not, that I think we all have to live with. For demographic trends, and we saw Mr. Milken and others putting up a lot of charts earlier today, we have to recognize the demographic trends that we're in. And I think since the war, in the Reconstruction period, it has been a great time to own equities. Our own view is that for quite a long time, global growth is going to be somewhere in between minus 50 basis points and 2% through the cycle. Because it's just harder to, because the big growers have grown, and China, it's the Larry Summers argument, it's the Japanification of the rest of the world, or less of the developed world. And so if that is your belief, I think there needs to be a much, much bigger asset allocation out of your standard 60-40 equities, government bonds portfolio. And I actually think private credit, the people, the top of the capital structure people, like most of us, the three of us anyways, who we don't need the world to grow. We just need to lend money at the top of the capital structure. If you have one of those geopolitical events, then you have security. If you don't, you just get paid back and you make, in our case, our sort of mid-teens returns. And I actually think that's the biggest thing that people have to recognize is there has to be an asset allocation. Equities was right since World War II. Not clear to me that it's necessarily right now.
But now I have to chime in here. First of all, I failed to introduce myself. I'm Hans-Paul Bürkner, the global chairman of BCG. But I think, first of all, the talk about geopolitics and stability in danger, I think we forget that the 25 years after World War II, there was the Korean War, there was the Vietnam War, and there was the worry about domino effect here in Southeast Asia. I mean, we had conflicts in South Asia, across Africa and so forth. So let's not underplay this. Of course, we survived, and that's why it was stable and there was no danger. And of course, going forward, we think everything is really dangerous and unstable because we don't know how the Middle East will play out. But we should not forget that despite the war in Afghanistan, Iraq, Syria over the last 10 years, less people were killed in the last 10 years in wars and civil wars than in any other decade before that. Yeah, I mean, just in Congo, we had more people being killed in the previous 10 years, which does not diminish in any way what has happened, and the enormous suffering. But I think we always tend to make the current times, and of course the future, much more unstable, much more uncertain than the past, because of course we know what the past. So that's, I think, one caveat on the.
Okay.
And you can.
No, come on. Okay. I think I haven't finished my speech in the first place.
Okay.
And it is very nice to be having this podium represent the one side versus for other people, and that's a great way.
No, that's not true.
No, I'm joking.
I agree with you.
Okay, don't worry.
Go on.
On the sort of two sort of the points for rebuttal. Number one, shortly after World War II, there were conflicts. Those were localized conflicts. Okay? And when I say danger, it's a danger placed upon the rest of the world. So let me sort of, it's not right or wrong, but it's one perspective. And I think the point about, the fixed income versus equity allocation,
Private credit versus.
and actually that will lead to sort of next sort of content of mine. There is a rising importance of active asset allocation and active asset reallocation, because you can imagine the shape of two mountains. Again, I don't have a slide. Number one, shape of Mount Fuji. And the other is the shape of Kilimanjaro. You had 30 years of a very good fixed income market. Okay? And are we going to see the shape of Mount Fuji like this? Or are we going to see the shape of Kilimanjaro with longer sort of a top? And I think everybody on this podium is hoping for the latter, and I think that is also my belief. Because central bankers are there to manipulate interest rate left, right, and center. And their excessive intervention will never end. They say they would ease the QE, whatever. Okay? And also, you would realize that ECB managed to shrink the balance sheet without asking, by letting, without many announcement, by letting assets to mature, but they're now going to come back again. And also, they're hinting that there is an additional sort of QE waiting. Key here is that we are in a very strange world. So when I talk to the students of economics, and especially Chicago School of Economics, I tell them they should forget the past data of monetary policy and price of commodities and price of consumer goods. After 2008 and 2009, with the strength of Basel III regime, Solvency II regime, and also new fashion of accounting for pension liabilities, all basically forced the people to shrink their balance sheet. And government is in the game of trying to look better in front of Standard & Poor's. So the central banks are the only game in town, and we see no prospect of central bankers shrinking the size of balance sheet anytime soon. I still remember having a private session with the G10 deputy governors in Basel back in 2009, when there was heated debate about exit, how they should do exit. So I raised my hand and said, gentlemen, you don't have to worry about exit, because it is not going to come.
In your lifetime.
There's an important point, I think, through the thread of this. This isn't about equities versus fixed income versus credit. One of the things I also think came out of the crisis is an awareness of who you are as the investor. What is the nature of your liabilities? And it seems that a lot of people I know what my liabilities are, and that's a natural thing. But a lot of the focus, especially I think in areas like some of the pensions markets, was about that yield and that growth. But then when the crisis hit, it became about that liability, because you went from a funded world to an underfunded world. And I think when you look at an asset allocation scenario, you really got to think about the client first. What is their needs at the end of the day? And some might have more of a tolerance for equities. We run a lot of insurance money. I can tell you in life insurance companies, it's a 90-10 world. You don't run 60% in equities. You run 90% in high-grade assets. And I think some of the opportunity when you get between the pure public equity world or even the private equity world in the fixed income world is looking at what else? Assets that generate cash flow, real assets, real estate, things like that, that are some of the areas that are, investors are looking to get into that might not have the level of volatility from equity markets, but do generate a cash flow, much like fixed income, but without the threat of an interest rate spike. So it's not a one-size-fits-all. We don't invest one-size-fits-all necessarily, but we do look at what are we trying to achieve in terms of the liability of the client.
Okay, Rob?
So I just thought it might be fun to think about this debate in Mike Milken's equation, right? So let's take a different angle at this whole debate and prosperity with that F multiplier. And maybe what we're all talking about in each of our different permutations and each in our high convictions is that F. What do we do every day? We do, hopefully, hard work, I think execution. I think ultimately investing is about not just the great ideas you have, but executing those ideas, and I think that's what we do. But it's really about that F multiplier, if we all saw the Milken thing. So in financial services, whether it's private credit, whether it's fixed income, whether it's asset allocation, whether it's really the leverage of the F. And I think that's kind of the fun place to debate, and maybe let's talk about that, or I think it's worth investigating that a little bit further, and how can we make more financial multiplier across what I think are the most important markets today, which are the emerging markets and arguably Asia. How do we bring about more F? Because ultimately we do have to create an exit for QE, and ultimately we need to execute financial leverage better. So can I take a look at page 11? And this is really a simple point that I think ties into some of the points we made before. But this is not the banking system. This is the rest of financial services, that F multiplier factor that are financial institutions across the world. And this is a fairly obvious statement, but everybody knows that what's really happened, in addition to the consolidation, the regulation of the banks, in addition to the priming the pump, that really the new big players is the disintermediation of the banks, is people such as ourselves who are the non-bank lenders. You can call us whatever you want, but we are balance sheets that are replacing the banks. And this has been this huge, the single biggest growth factor in the US and in Europe. We've seen it in Japan as well. And I think the simple point I'm trying to make here is this is the next wave in Asia. And if you want to succeed in helping in Asia, and I think the regulators are right on this, in China and Japan. And so people sit there and get scared about that F multiplier, the shadow banks specifically in China. But frankly, direct lending, when well practiced, when well executed, right, it really is, first of all, absolutely compelling yields. But it is the growing and the fastest growing components. Those little bottom numbers are the ones that scare you, right? So let me see, shadow banking, call it that, has grown at 74% in China over the past 5 years. That scares you. But conversely, as a percentage of the lending market, it's still, you can argue this number might be 11% today, but it is still where the evolution of the capital markets need to go. And so how are you going to replace the central banks? How are you going to bring a more disciplined capital market? These are the day-to-day new balance sheets that are frankly replacing the banks. And I think an important component, if we want to get down to where's some treasure, there's frankly treasure in owning equity. Not just lending, owning equity of financial institutions that are not the banking system.
Actually, when you think of the 1997 Asian financial crisis, it was a mismatching of currency and maturity between asset and liabilities of banks that basically killed Asian economy. In 2015, Asian financial institutions, banks and insurance companies included, are very strong. The question is, what are they doing to fund very important infrastructure funding needs of Asia? The answer is they are unable to fund. So the only place where they can find a sort of long-term money is to produce a long-term capital markets, either liquid or illiquid, in Asia. Challenge is that people in Asia love banks. They love banking accounts. they keep money with the banks for a long time. But banks cannot treat those deposits as long-term liabilities. And therefore, they cannot invest in long-term needs of infrastructure needs, corporate needs. So here's the conundrum, okay? US capital market is great because US borrows lots of money from the rest of the world and reinvestment. Okay? What is missing in Asia is a source of long-term money. That is pension. And that is also life insurance companies. So to solve your conundrum, or actually Asian regulators are better off trying to produce long-term source of money so that they could be recycled, and a good part of that could be recycled into public debt, corporate debt, public equities, and most importantly in the alternative space. Because it is the long-term liabilities that will be able to drive future growth of this region. And I think Asia is perfectly capable of it because the people in Asia, individuals, have money.
I think, can we go back to one of the key issues that all of you, I think, emphasized, is that really focusing not just on big markets, the average, the indices, but really trying to pick whether it's specific credits, specific equities. And I think one of the things that we also have to recognize that in each industry around the world, no matter how poor, like paper in Europe, for example, is a very poor performing industry. You have outperformers and you have very underperformers. And the differences are huge. And so I think even though growth rates have come down, even though we see a lot more instability and uncertainty, I think there are always outperformers. And we have seen, especially in Asia, we've seen high growth rates. And there will be companies who will continue over the next 5-10 years to quadruple, maybe even grow tenfold, as we have seen the last 10 years. And these are also the ones that will generate the value, the total shareholder returns. And I think we need to be maybe more differentiated than we have been in the past. I think you made that point very strongly.
Well, yeah, and maybe I'll usually you say to build upon somebody else's point, but in this case, to build upon my previous point. Supported actually by Rob's slide, so thanks for sharing that with us. And since we're in Asia, we invest globally, but since we're in Asia, let's talk about Asia. Everybody wants to be a part of the Asia growth story, and we get the demographics, and indeed we in 2010 and 2011 we have the ability to have our capital anywhere. In 2009, it was almost 100% in the U.S. because everything was priced wrong. If you're still standing in 2009, anything you invested in, went up. But right about, we got lucky with our timing, literally 2 or 3 weeks before the European debt crisis, in sort of April of 2010, we did a major sort of shift from North America to Asia. And we went from almost everything to U.S. to 85% Asia, or cash. And but the way in which we did it is what I'd like to focus on. We said, well, where do we want to focus? How do we want to differentiate? Well, we figured that trade was going to be an important place, Asian trade, export-led economies, and trade finance would be a very, very nice place to do that. And here's where I guess I'll disagree with Rob a little bit, in that I really think that we did a large transaction, a multi-billion transaction, working with the banks, where they originated 14,000 trade finance loans. And those trade finance loans matured every 61 days. And yeah, I love the concept of direct lending, but you know what? HSBC, Standard Chartered, you pick them, they're really good at that. They've been doing it for a century, or over a century, and they've been doing it well. And their losses in Asian trade finance, even including the 97, 98, were very small. And as much as I'd love to disintermediate them, I don't think I have the infrastructure to go and make 14,000 loans that mature every 60 days. So that's kind of point number one is if you want to differentiate, yeah, of the 53 trillion, I don't love everything that banks do, but I don't have to do everything that banks do. I can say, again, let's go to Europe for a second. I don't know if I love, Commerzbank as a bank, but I think they're really good at doing Mittelstand, middle market German lending. I don't know if I love Barclays, even though we have in our midst the ex-CEO of Barclays, but if you look at Barclays, they have been for not 3 years or 30 years, but hundreds of years, they've been really good at middle market lending. And that's how you differentiate, and that's how you find that. And my only final comment on direct lending is, I think you said it. I think you're unique because you're a direct lender who's done it in Asia very well, and that's fantastic for you and your stakeholders. But and I think General Electric, until they recently just sold, was a non-bank that did middle market direct lending very, very well. Yep. But I think that they're the exception because these direct lending, they look really well. They look really good business plans, sort of 4 or 5 years into a growth cycle. But the big problem I have with this over disintermediation away from the banks is it's pretty easy to lend, but when things go wrong, I like to have those 200 or 300 sort of lawyers that the banks have, and those workouters, and those local sort of people in Dusseldorf and Detroit. And I think that we should not underestimate. And that's, again, if you think that we want to go not for the Johnny Walker blended approach, but the castrate Spring Bank, I think we should not underestimate the installed base of branches and market knowledge that our banker.
Let's be fair, too, to differentiate between commercial lending on a broad scale, small ticket lending, and making a loan to maybe a sponsor-driven LBO with a company from 10 to 20 million EBITDA. I don't disagree. There's triad finance. Banks are in a better position to do certain types of lending. I think what you got to look at is what are the different types of lending, and where does capital flow into it? If you go back to late 1980s in the U.S. market with the leveraged buyout boom, when the high yield market went down, what replaced it wasn't those loans being syndicated from J.P. Morgan Chase to Mellon Bank or to foreign banks. It was replaced with the institutional market, in essence, a broadly syndicated market. So I think the one thing is, I agree. The goal here isn't to replace the banks. In fact, we did our first middle market investment. We have a fund that was raised in 1973 that's been investing in U.S. middle market companies since the early 70s in the mezzanine debt. It's just the movement of institutional capital into the lending market where it can be employed efficiently. You have a model for employing it in certain assets, certain types of loans. We have models too that are tested over the years. And so I think the key is understanding, whether it's the manager or it's the venture that you have, how that asset's being originated. And once that's owned in a portfolio, to your point, how's that managed? And how do you manage risk?
And just the only small sub-point, what scares me, I was at a conference in Korea, this is a small point, sorry, is I saw Preqin, the guy going right before me was Preqin, and he talked about something like, and this was in May, so it's grown, I think, since then, $25 or $28 billion that's being raised right now for direct lending into Europe. Now, and most of those people actually aren't backed by MassMutual. They don't have the infrastructure, and I actually think that that's a problem.
Actually,
but they have to get it to work.
Okay,
right. Okay.
Bata-san.
Okay. You are missing the point of or actually geographical diversity of a banking sort of a system. United States, they've been very regulated, and also they're in the game of selling their assets, making money. Very healthy market. And also residential mortgage market helps them. Okay? European banks hated selling any assets until recently, when this leverage scheme found its way out of the United States into Europe. So one is sort of they are unwilling to work closely with you, but they have to work closely with you. Okay? Asian banks, they are strong. Okay? They have no reason to worry about their balance sheet yet, and they have no reason to worry about the equity level yet. So your model will be very powerful when there is a debt crisis popping up in Asia. Until that happens, he will be smiling.
Well, the good
So I just love this. You know, how many panels have you heard people debating various niches of the credit space, whether it's, you know, commercial lending or private credit or take from the banks or participate with the bank? This is great. You know, usually we're just sort of one little niche strategy, and I think that is indicative of what we're seeing coming forward. That frankly, in a 1% world,
I think taking a
credit is interesting.
Yes, and yes, that's very important, but also taking a differentiated approach is very, very important. I think much more than just following the crowd. We have a few minutes left, and I wanted also to have a chance to engage the audience. Questions? No long statements, please. Just short, sharp questions. Any questions? Do we have a microphone here? It's coming. Thank you.
Hi, I'm Chris Langner from Bloomberg. Just a very quick question. You guys who lend directly, especially in China, in the case of Rob over there, how easy is it to get recourse when these guys don't pay? And how much of your portfolio actually doesn't get paid in the end?
So I'm going to stick with the short answer to that. And I think a couple of simple points. Everybody forgets that after the Asian financial crisis, every single country in Asia changed their bankruptcy code. It's a huge statement through the legislative process. So people say, you know, you don't know how to collect in Asia and enforcement doesn't work. Simply not true. And there's a country-by-country answer. And frankly, you know, North Asia is substantially better. The quick answer in China is if you're hard assets and if you're property, so i.e. if you don't have employees and you don't have taxes, you can genuinely be the top of the cap structure. The other thing I would quickly say is precisely to that reason is why we like to write our own documents rather than buy documents from a state-owned enterprise bank.
Very good. Other questions? Anybody wants to shift his or her investment policy now after what we've heard? It's getting toward the end of the day, I guess. Oh, there we are. There we have one over there. Mic is coming.
Hi. Mr. Petty, I think you mentioned earlier that equity and financial-related institutions, fintech firms, that's an interesting investment from your perspective. I assume you're not talking about the average P2P lender, but maybe you are. Could you elaborate a bit on that and where you see opportunities in the equity side with regards to financial institutions?
Two quick things. One, non-bank finance companies in India. So the MBFCs in India, they're publicly listed ones, they're private listed ones. We've created one called Altico that has $300 million of equity co-invested by some big sovereign wealth funds and the like, and we think that's just a very interesting financial platform model. Build a credit portfolio, put a modest amount of leverage on it and do it. And I think financial institutions, you can get net asset value builds, stable returns in an unstable world. So I think it's true in India. China, it's harder. The quick answer is we actually have a control platform where we're running the business rather than somebody else. That matters to us in execution. But I think the best public examples for everybody would be Huarong or Cinda. Look at the big, giant Chinese examples. And so to just say, why do I think fintech is interesting? Simply put, and you can debate this, everybody made money on the Chinese banks' IPOs. Everybody made money on the insurance companies in China. Everybody, quote me, has a real prospect, qualified, to make money in the asset management companies. This is next. This makes sense. They are the non-bank lenders for a developing capital market in China. And if we just look at the timing of the Huarong IPO, it got postponed because of the volatile markets. But if you look at the 14 subsidiaries of that company, Cinda is very similar. 14 different subsidiaries. It looks like there's securities lending, there's commercial lending, all these different subsets. It's a very logical step in the development of the Chinese financial market. So do you think that can trade at a multiple to book? I do. But the businesses themselves make money. So fintech, can get worried, you can get worried about it, and you should think for the long term, but frankly think it's a really interesting, logical development.
Shibata-san, do you have any thoughts from you on that question?
I think actually what is happening around the world is the courtesy of regulators. Global financial institutions are becoming utilities. Very stable, not interesting, good business partner. But there are also people who will be there to disrupt the incumbents. And actually, you are finding many of those trying to sort of make their debut in places like China. And some will do with the banking licenses. Some will do it without any need of doing it under banking licenses. I think combining the great trend for the growth of emerging markets with the growth of emerging financial service sector, I think there's a good chance that you can make money.
Very good.
So, sorry, can I follow up? Just one question.
Yep.
So you mentioned Cinda, which is trading at 0.8 times book, right?
It is.
Huarong is trying very hard and struggling and probably won't be successful in IPOing at 1 times book. So at least in the current environment, there's no earnings multiple, right? So given that, on an ROE basis, do you think these businesses will be a better risk-reward kind of investments as compared to your core business, mezzanine lending and private debt and that sort of thing?
So, I think they are our core business, frankly. I think, I wouldn't go out and buy that equity. That's not my business. But I would go out and build a platform where the ROE is compelling. And, we can sit there and talk about 0.8, and you bought into 0.8s at the global financial crisis post the US and a bunch of financial institutions, and you made a bunch of money. So the core business still is compounding, right? And then you can go to it. So your point is 100% right that it's a difficult IPO world today, but that doesn't mean the ROE of a well-managed financial institution isn't going to compound at, very interesting double-digit rates. And you will get a multiple to book 5 years from now.
Yeah. One last question here. We are out of time, but we'll just allow one of them.
Thank you very much indeed. This is Stefan Kosciuszko from the asset manager CQS. Using the opportunity of Shibata-san on the stage, I can't think of anybody who is more experienced and has seen more change in Japan in the global market. So I know we all like to talk a lot about China, but could I just focus upon Japan and get his views, where he thinks the market there is moving, and in particular, any special tail risks that he can see on the horizon?
I think I try to be very brief. I'm an optimist, largely because government means a business. And the people talk about first arrow, that's being done, QE. And second arrow, that's fiscal spending. Third arrow is what the Western press do not really understand for the next 10 years. But actually, you have not seen any government publishing 115 KPIs. Each of KPI has a sponsoring minister. So one minister might have 10, other one might have 15 KPIs. And they are accountable for it in terms of semi-annual reporting, and also semi-annual progress report, and semi-annual correction items. Probably 115 is too many dots on the wall, but some of them basically stick. And effect of that is like a Chinese medicine, pain now, money goes to pharmacy now, effect later. But actually, there is a serious attempt being made by the government on the third arrow. The other thing that you shouldn't trust what comes out of reporting from leftist media. They're good in manipulating numbers. But actually, it looks as if consumption is up, and also wages up. And actually, when you see construction companies turning down the opportunity to participate in the public tender on the ground of a shortage of skilled workers, there's something going on. And looks as if the Japan is a country without any excess capacity for now. That's a major sort of statement to make. Or actually, GDP gap is either zero or negative. So great opportunity to play your money. Kind of shorter term, like 5 years. No guarantee that you'll make money in the next 20 years when the country faces a bigger challenge of social welfare bills and debt service.
Very good. Thank you very much. Thanks very much. I hope you really got some ideas of where to put your money. And please share also your rewards with us then. Thank you very much.
Okay.
Well done. I think it was good.
It's good.